Question 51. A decline in the effective duration of a callable bond most likely implies that a bond's A, yield to worst has risen, B, yield to maturity has risen, or C, benchmark yield curve has shifted downwards. So as far as yield to worst and yield to maturity, these won't necessarily have any effect on the duration of a callable bond. These are more so just kind of measures of what the worst possible yield is of that bond at the time, and then what the worst possible, or not worst possible, but what the expected yield to maturity is of that bond at that time. It's not necessarily going to reflect anything about the duration. So then looking at answer C, benchmark yield curve has shifted downwards. So a decline in the effective duration would imply that the yield curve has shifted downwards. So if rates decrease, essentially what this means is that the price of that callable option goes up, and it basically becomes more likely that the issuer is going to call that bond back. And so when it's more likely that the issuer is going to call that bond back, it's more likely that bond is not going to make it to maturity, hence the decrease in the duration. And so that's kind of how that works. When the rates go down, that callable bond duration is also going to go down. When rates go up, the duration of that will go up closer to what the maturity of the bond is. Answer C. Question 52. Which of the following is least likely an example of an internal credit enhancement? So we've got least likely. So two of these will be internal credit enhancements and one will not. And as a reminder, internal enhancements are kind of strategies used within the company, whether that's a structuring of the finances or some other thing done internally to kind of reinforce the balance sheet or the resources of the company that kind of makes them a stronger credit, essentially. So looking at these, we've got A, claim priorities to the underlying assets are ranked. This is going to be a type of internal credit enhancement. Internally, they decided to tranche out the priorities on the assets. And so this reduces risk for investors that are higher up in the capital structure. Tranching is an internal decision, and it helps give investors kind of choice of where they want to be in the capital stack. B, posting more collateral than is required to secure financing. Again, this is going to be incorrect because they're using something on their balance sheet, collateral. So this is an internal measure to secure that additional financing. And then C, providing a credit line to reimburse cash flow shortfalls backing the issue. This will be our answer since this is going to be an external credit enhancement. That credit line is coming from some bank or other external institution. So they're using this external source of funds to reimburse cash flow shortfalls. Answer C. Question 58. A firm enters into a repo agreement to sell a 4% 12-year bond with a par value of $1 million and a market value of $975,000 for $950,000. And to repurchase it 90 days later, the repo date, for $955,000. The repo margin is closest to. So essentially what this is going to be kind of the haircut that's applied to that repo. And so the difficult thing here is figuring out which value to use. We've got the par value, we've got market value, and we've got the selling value, the amount we're repurchasing. There's a lot of different items here that we could plug into our formula. So our repo margin, or haircut as the different way to put it, is going to be that market value, so 975 minus the amount loaned, which is we're loaning it for 950, and then divide that by the market value. So that's going to be our margin, which would be 0.0256 or 2.56%, which is going to line up right here with answer C. And so essentially what this 955 number is, if we were calculating the return or the borrowing cost essentially, then that's when we would be using the 955 number, because basically the firm is going to is borrowing $950 and then giving $955 back using this $975 asset as collateral. Question 54. Which of the following most likely measures the sensitivity of a bond's price to changes in the benchmark yield curve? So we've got A, effective duration, B, modified duration, or C, Macaulay duration. So Macaulay duration is going to be more cash flow based, and this is basically telling us how much, if we have a change in rates, what is going to be the amount of time that it takes for us to get our money back based on the price loss that we have there. So that's not as much going to be based on the benchmark yield curve. It's going to be more so kind of cash flow based. So we can rule that out. And maybe not more so cash flow based, but kind of the individual bond, specific bond based versus kind of being based on the benchmark yield curve. B, modified duration. So modified duration is going to be based on changes in yield to maturity of the bond, assuming that expected cash flows don't change. So it's not going to be based on benchmark yield curve. It's going to be based on the yield to maturity. And then A is going to be our correct answer. It's measuring sensitivity of the bond's price to the yield curve, effective duration. Answer A. And this is a tough one. I guess last thing I'll say is just, these are tough questions because it's more so just memorization. You kind of need to just remember, commit to memory these different definitions of effective duration, modified duration, and Macaulay duration to know those differences. Question 55. A 5% annual coupon paying bond issue has a term of maturity of 6 years. The bond's par value is $1,000 and is trading at a yield to maturity of 7%. The bond is most likely trading at par, discount to par, or C, a premium to par. So to be trading at par, our coupon would need to be equal to the yield to maturity, which is not. So we can rule out that right away. And then between discount to par and a premium to par, we'll be comparing that coupon to the yield again. If yield to maturity is greater than coupon, we're going to have to be at a discount in order to support that higher yield to maturity. So this is going to be B, a discount. And then for us to be paying, or for it to be trading at a premium, our coupon would need to be greater than our yield to maturity. So I'm going to pull up the calculator here to just kind of demonstrate this using time value of money, the time value of money calculation. So we can calculate the price of this bond based on the information given, and then we can see whether it's at a discount or a premium. And you can go in and do this yourself later to kind of tinker with the numbers and see how that coupon and yield to maturity affects it. So we've got N of 6 for 6 years to maturity. Our interest rate is going to be 7%, which is given. Present value is what we're going to be calculating. Payment is going to be 5% times the par value, so 50. And then future value will be 1,000. So we'll hit compute present value, and we can see that comes in at 904. So if the bond is trading below par, that means it's trading at a discount. And so if we go in and make this, if we adjust this example, so if we make our payment, let's say $80, so that would be an 8% coupon. And now we compute present value. We see now it's trading at a discount. And lastly, if we do 70 or 7%, we can see that puts our, there we go. We can see that puts us at par. So coupon above yield to maturity, premium. Coupon below yield to maturity, we're at a discount. Coupon equal to yield to maturity, then we're at par. Answer B. Question 56. An investor considers purchasing a 10-year bond priced at $1,052 with a 7% coupon paid semi-annually. If the comparable bond's yield is 6%, the bond is most likely A, undervalued by 21.6, B, undervalued by 22.39, or C, overvalued by 21.6. So what we're going to do here is we're going to take all this information, so 10-year bond, 7% coupon twice per year, and then yield of 6%, and we'll plug all of this into our calculator, and then we're going to calculate present value and then compare that to our bond priced at $1,052, and that'll tell us whether we're over or undervalued by one of these amounts. So for N, we're at 10 years, but twice a year, so we'll have 20 payments. Interest rate is going to be 3 since we're doing semi-annual, and yield is 6% annually, so we need to divide that by 2. Same thing for the payment. We're going to have 7% divided by 2, which would be 3.5%, and then multiply that by 1,000 par to get our payment. And then for future value, we've got par in there. So we'll hit compute present value now. And so we see that, we see that gives us that gives us 1,074.3874. So what we'll do here then is we need to just figure out the difference between that and 1052. So I'm going to add 1052 to this to get that difference. And we see that comes out to 22.3874, which if we round that up, we get answer B right here. Question 57. An increase in market interest rates will most likely benefit the holder of A, a call option, B, a put option, or C, both call and put options. So for this question, I'm going to pull in the formula for put-call parity because I think this is a helpful way to walk through it. So for put-call parity, we've got the underlying plus the put equals the call plus the strike price of our option discounted back to the present value. So for the call option, and so we're looking at market interest rates. So this R value is kind of what we're evaluating, whether this benefits the call or the put option holder. So if this R increases, was that going to help the call and help the put? So to rearrange these two formulas for the call, then it's going to be, we're going to move this over to the other side essentially. So we're going to get the underlying plus the put and then minus the risk-free bond. So essentially, when we're looking at this, we're subtracting out this portion, which has the R value in there. So what's going to happen here is this R value, as it increases, since it's in the denominator of this part of the formula, it's going to make this whole value smaller. So interest rate increases, the value of this is going to be smaller. And so when that becomes smaller, that's going to increase the value of this put option. Or sorry, not of the put option. It's going to increase the value of the call option. So again, this R going up is going to make this whole value smaller. And so since this is a negative value, we're subtracting out a smaller amount, making the call option more valuable. On the put option side, this is now getting added. So the same principle still applies. R goes up. This whole value here then is going to decrease. And so since we're adding this, that decrease is going to lead to less benefit to the put option. So we can rule out both in the put, and we go with A, only benefits the call option. Question 58. Which of the following is least likely an exchange-traded derivative instrument? So least likely, so 2 of these are going to be exchange-traded and 1 will not. So we've got A, futures, B, options, or C, forwards. So futures and options, we'll rule those out. Since those are exchange-traded, they are traded through central exchanges, and they're going to be more standardized contracts. Forwards are generally going to be over-the-counter and more customized, used by institutions so they can get specific currency or interest rate exposures that they want there. Answer C. Question 59. Which of the following statements most accurately illustrates a consequence of arbitrage? A, short selling becomes restrictive. That's going to be incorrect. If we want arbitrage, then it's not going to restrict short selling. It's actually going to kind of be encouraged, because if we want to arbitrage values and we think something is overvalued, then we need to be able to short it, not just not buy it. Answer B, the same good can sell for different prices in different markets in the future. That's going to be incorrect as well, since if we have strong arbitrage, then that same good, if it is selling for different prices in different markets, the arbitragiers will be buying and selling, buying at the high prices in one market and selling at the low price in the other market. Other way around, buying low in one market, selling high in the other market, and those prices should converge over time. And then C, the combined actions of traders would force the convergence of trading prices. It's basically what we were just talking about for B. If prices are different in different markets, there's going to be the buying and selling that the arbitrageurs are going to do to drive those prices together. Answer C. Question 60. Downside risk is the financial risk associated with losses. Which of the following single option transactions most likely has the highest downside risk? A, buying an in-the-money put, B, writing an at-the-money call, or C, buying an out-of-the-money call. So of these three, we are buyers on A and C, and then in B, we are writing or selling the call. So in the case of buying, our downside is going to be limited to the premium that we pay. So we buy a put. If the price doesn't fall enough for us to exercise, then basically we're just out the money that we paid in premium. And same thing on the call. So I think we can go ahead and rule those out. And then whereas in the case of writing an at the money call, if you get exercised, you're going to have to deliver shares at the strike price. And in theory, that stock price could go up to infinity. And so you really don't have a downside in this scenario. The stock price can just keep going up and up and up and up, and you'd be forced to kind of deliver at whatever the strike price was, and then which means that you're selling there but having to buy the stock above wherever you sold it at. So we're going to go with B. Writing in at the money call is going to have the highest downside risk of these three options.